Okay, cool. So market just opened. Let's check out the action. Alright, we're going to see well, so far it's still bullish. Up $1.50. Morningstar. Oh, okay. Yeah. It's funny with this new stream settings. I can keep hearing myself, and it's also in 1080p HD if you're interested in watching everything really clearly instead of all grainy and like shit. Okay. LinkedIn. Okay. Twitter. GoPro. What we make of GoPro's earnings. I'm gonna read this because I'm interested in GoPro. In fact, let's check out GoPro right now. Yes, underperforming. That's what I like to see. I love to see that, actually. Because, quite frankly, I think GoPro is going to lose. GoPro share hours before tanking on news of the CEO's resignation weak guidance. Oh, shit. Okay. So, the weak guidance supports our model viewing the present value of the stock. We believe the concerns over GoPro's IP remain very real and maintain our $36 present value for the stock. Right now it's trading at 47. Okay, nice. I might actually I might actually want to enter this trade for quick pop of cash. I'll see how that goes. Initially up 14% on fantastic numbers. Okay, that's good to know. Beat estimates, but now stands 15 below its closing price. Below numbers. Okay. Yeah, we expect the guidance in our first article on GoPro. We explained that we didn't think the analyst pegged growth rate of 30% was a reasonable growth rate. We believed 30% an optimistic growth rate and calculated accordingly using our model. Analysts expected a 112.5% year-over-year EPS growth in the first quarter of 2016, but management said that growth rate could be 87.5% or 78% that of analysts' expectations. We believe GoPro remains a good short. Our $36 present value. Cool. Where's the morning thing? I have a new direct message. Okay. No. Huh. Okay, let's check out Seeking Alpha top stories. Wall Street Breakfast, Radio Shack. Yep. Dump Twitter. Okay. I'm actually pretty bullish on Twitter. Whatever. Quarter looks like a sell. Income growth versus dividend growth. Okay, so nothing super huge there. Check out the chart again for the market. Okay, so down 29 cents. So it looks like we're going to either have a slightly bearish day or slightly bullish day. We're going to see if the market can crack this head right here. I wanted to see it crack this resistance line. Because personally, I want to make more money. That is my preference. And I hope you have that bias as well. Okay, Berkshire Hathaway is up. Target, slightly down. Not awesome. Financial sector, fuck yeah. Love it. Okay. What else do I have? I knew that I had something. TLT, bonds. Okay, that is... Well, I mean, I guess it's kind of expected. I have a 6-month position on it, so we'll usually have an inverse relationship with the market. I can't wait till I get used to streaming and talking at the same time, because that would be fantastic. Okay. Okay, that is better than I would have hoped for it, actually. Surprisingly enough. I still got a little bit of time on that, so no reason to close that. I'm going to check out the heat map. If you don't know, you can just go to Fin, check out the heat map. Okay, everything is very cold. Everything to heat up once the market's been open for more than 6 minutes. And so I'll go into a little bit of market predictions for the day. TLT, that's obviously down. I am definitely predicting, I don't usually, oh well, okay. Yeah, I still maintain my position on it being either a slightly bearish day or bullish. Right now there's definitely bullish vibe. The market definitely looks like it just wants to climb higher. You can tell by this bullish harami, almost this I mean just this just the trend pattern. I really want to see it crack up to like right here. If we can get like $5 more, that'd be higher, and then it's probably just going to keep climbing higher. And we'll see if we can also crack this head right here, go to all-time new highs. All right. If you're new to this, you can go to stockcharts.com, free chart. Simple moving averages 750 and Bollinger Bands. And I also like to have the slow stochastics. Well, actually, it doesn't matter. I can read both. They give you more or less the same reading. So it's starting to expand right here. Okay, hold on. I'm just going to rice. Nice. Rice. Yes, that is the thing that I like to eat. And fill the chart in 6 months. Okay, sweet. So, as you can see right here, it just ever so slightly just wants to expand, like just right here, just very subtly, just right around this area. It's starting to crest upwards, which is the best sign. 7-day moving average moving upwards. Stochastic growth, it's still cresting upwards as well. Hopefully we see something like this where it just maintains that high. And I would love to see all that. In fact, I mean, ideally it would just go all the way up here and then it would just stay up here, but that would probably be, artificial inflation. Man, I'm starting to feel like really my vitamins are starting to kick in. I had some St. John's wort, vitamin D, ginseng, all that different stuff. So Twitter, LinkedIn, pre-market gainers, losers. I actually kind of want to see last chance dub Twitter. Okay, so XLS up 36%. Holy cow. Okay, Twitter. Okay, I think that's why they're saying it. Not because it's a loser, but because it's just going super high. Yep. Man, I wish I got in on that yesterday. I wish I checked that. That'd be incredible. Wow. LinkedIn up 10%. Yelp down 16%. Okay, fair enough. I'm not a fan of Yelp. I mean, I guess I kind of am. Okay, Dana Blanken. We have. Up 12% in pre-market on fast revenue growth and smaller losses. Ha! The company has promised to address issues like trolls, bad code, and monetization. It doesn't matter if the company is run to benefit managers rather than shareholders. Okay, whatever. Still, I like Twitter. That is the thing that I like. Okay. I'm just gonna get into the training. Oh yeah, if you like the new templates and setups that I have for the stream and for the documents that I'm starting to make now, you can just, give me compliments. Give me lots and lots of compliments. Oh, hold on. Oh. Yes, that is what I wanted to check out. I'm not ashamed of the one person being me. The one person must be me. I am the one person. Okay, so 10 minutes, got a reasonably good idea of what the market is like, and I'll just get into today's training. So today is what if. Getting clarity by asking yourself tough questions. Oh, there doesn't need to be that question mark right there, but you get the point. Oh god, it's like getting clarity by asking yourself tough questions. That's actually an interesting format. So today I want you to meditate on the thought of what if, and I want you to relate it to Ty's chest-like assiduity. And if you don't know what that is, it's basically you sit in a chair and you think, what would happen if this happened? Or why would this person be acting like this? Is it because of this? And then basically what Ty says is to ask yourself why 3 times. What I'm saying today, on a similar note, I want you to say, what if? And then I want you to solve all those tough questions for yourself. So we're going to run into times when we're not going to do so great in the market. And let's just look at the market right now. It's just very choppy. If someone got in right here and then they're expecting it to go back up, well, too bad, because it's down. And then all that time waits, all that time passes, and they're either at the same place or they're slightly down because their options are starting to expire. And if you're maybe right here, then you end up right here. But then you think you're going back up, and then you maybe sell right here. If you're smart or lucky, then you sit, and then it goes right here. Or you try to sell it right here, but then it ends up right here, and then it's worth probably like this much, just because of time expiration, the time decay. So what would happen if the market absolutely crashes? Or what if there's even just this small market correction? How are you going to behave? Well, I know that if the market crashes, how I would behave is depending on which position I have, I probably wouldn't care that much. And I say that just because right now I'm taking really long-term positions just because I don't know necessarily where this market is going to be. I mean, if you look at the recent price action, could it be down here again? Yes, very easily. Could it be climbing higher? Yes, not as easily, but it still has that potential. So, what's the safe option? The safest option is to either take a longer position or to day trade. So, you are sort of in this extreme place right now. I mean, technically, if you predict the stock to go back down, start to channel, you can play the bear. Then you say, I'm going to play right here, predicting it to go down here. Or you can say, I'm going to predict this going here to all the way up here. Now, are these signals stronger than these signals or these signals? No, they're about even. So, I mean, there's no reason why it couldn't be down here, but I think the market generally wants to see it up here. If you see these Bollinger Bands just starting to expand outwards. But is that for sure? No, because we can't actually ever talk in complete certainties with the market. All we can do is try and use past experiences to predict the future. That's basically the best that we can hope for as humans with, you know, experiment and experience and you know, reasoning power. So you need to ask yourself, do you actually care about the money right now, if in case you lose it, or are you a gambler, or do you want a more guaranteed income? Because I know in, you know, a few months, maybe a year, this market will still continue to rise. It's not like we're entering a depression. So right now it's just entering consolidation, which is not the same thing. It's just flat. It's just, you know, no, it's not even really consolidation. It's just more, it's channeling. It's just going along the same support and resistance lines, and then we're waiting for a break up or, you know, a breakout or a breakdown in either direction, and then that'll give us our market signals. So what are you going to do? What's your strategy? You need to think of this right now. If the market starts to crash, how are you prepared? And what are you willing to lose, or what are you willing to risk compared to your reward? A lot of stock trading is about risk reward. So, you know, are you willing to potentially go down here in order to go up here? Are you potentially willing to go up here to go with put trades on the downside, betting on the market to go back down? Just ask yourself a few of these questions, and then I think you'll be better off. I really want to see these heat maps. I just get super excited about the heat maps. That's like my favorite thing. Okay, so it makes sense that XLF is up. Nice. That's what I like to see. Okay. So concerning your personal strategy, what would happen if you needed money right now? So, but at the same time, this right now is a short-term strategy. The extreme of the right now strategy is a binary option, where you try to make $100 in the next 90 seconds, but it's not really any better than just a bet. I forgot the software that I tried out one time, but basically it was just as a visual. Okay, just imagine this chart, except it's just like constantly moving. This cursor just like boop, 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 boop. You can't really predict it. You can sort of guess where it's going and then just hope, and then at some point it gives you the sensation that maybe you're winning, but you're really not predicting anything, because at the last second it could be up here and you say, okay, I want to put a call option on it, and then all of a sudden it's just like poof, and then at that point it's just gambling, because you never really know, because you're going to be wrong maybe like 30-40% of the time, even more, maybe like 60-70% of the time, but basically half the time you're losing. So that's not your reliable strategy. Now you could look at minute charts. You could say, I'm going to go to, let's say, Coca-Cola. I don't want to look at the options. And you could say, wow, that's a lot of minutes. Okay, and you could say, I'm going to trade based on all these minute charts. The market is opened. It's been more minutes than this, but you more or less get the idea. You say, okay, so this minute is passed, this minute is passed, and just trade based on this action. You're going to say this candle is right here, and it's a hammer pattern, so it's probably going to go back up. Oh, now it's a star body, and I made money. Now I'm going to sell, and then that's sort of that extreme. That's why I don't like day trading, because you need to make a profit within 5 minutes, and it's very rushed and hectic. And I don't know if you've ever experienced 5 minutes of in-depth trading, but it gets fucking intense, and you can't really make good decisions in a 5-minute range. So what if you need money for debts? Well, that's sort of a short-term to medium-term to long-term strategy. That's, I'll say it's like sort of a medium-term strategy. So if you needed money for debts, then what's the best strategy for you? Well, maybe you'd want an income portfolio, one where it paid you dividends every single month or every single 6 months or year, semi-annually. And every time that comes in, you make a little bit of money. Maybe you could also consider medium-term trades, where maybe you put in 2 to 6 months on a trade, and then if it goes up or makes you money, then you just exit the position earlier. Then that's a solution for solving debt problems. And you can set it up so you can do these more passively, so you're not always actively monitoring it. And by monitoring it, I don't mean checking the position to make sure that it's actually profitable once a day. I think anyone can do that, but I'm not saying that you need to be on it like a hawk. You don't need to check it 10 times a day. You don't need to exit the trade in 5 minutes. If you go to the bathroom, you don't need to worry if it's making money for you or not, because if you place the trade correctly, then over time, yes, it will make you more money than it loses. Now, let's say you're getting money for retirement. Well, what's the best strategy for that? Well, this is the kind of strategy where you want to put a big nest egg into. So this is where you're going to basically all your life savings. And the best strategy for this is something that's slow growth, predictable, and will definitely go up. And the average investor, what are they going to do? Right now, they're probably going to put into a retirement account. If you're in the States, you're going to put in IRA. If you're in Canada like me, then you're going to put it into your RRSP. And if you're smart, then you put into your Roth IRA or 401k even. I'm not even sure if there's a Roth, but that would be also acceptable, I feel. If you're in Canada like me, then you're going to put in your TFSA, and then you get tax-free savings. Once you take the money out, then there's no taxes on it. And luckily, you can also get Canadian and American self-directed accounts, so you can just trade as much as you want, and then it's not going to get taxed in the end. Unless you get too much money, then the Canadian Revenue Agency has actually cracked down on people that make a lot of money from TFSA accounts. But at that point, if you're making hundreds of thousands of dollars, maybe millions or more, then I think you can afford to get a small amount of tax. But it's still not ideal. But that's a good retirement strategy in general. Something else that people do, they put index funds. Well, if you put it into index funds right now, is it necessarily a good investment? I mean, right here it was 1925. Up here it was 2064. So let's say you had $1. Like one share of the S&P 500 large cap. So you have this much, and you end up with this much. You end up with about $140 extra. That's pretty good actually. It's not bad. Down here, 1875. go right here, make almost 200 bucks. So you put a lot of your savings in there in return. If you look over the long term, let's not just look at 6 months, let's look at the performance over the last 3 years. See, you could be all the way down here, potentially even down here, and then end up all the way over here. So it ends up from about 13 to 1400 to about 2000. So if you waited 3 years, then you get a, what percentage is that? I guess you almost get like a 30% gain, about 10% a year. So those are better than average returns. Plus, if you're self-directed, then it has no fees. If you were with a money manager, and honestly, money managers, they're not going to put you into an index fund because they want to be able to outperform the market, because their mentality is basically, if I can't outperform the market, then why are they with me? No, they could just do this strategy. They're coming to me for the badass tactics. So that's why they go into all these offhanded or off the beaten path sort of trades and investments and tactics, and try to advise you on all these alternative investments. Something else people do, mutual funds. I'm not a fan of mutual funds. That's just a personal preference. Other people like them, but I just think they're loaded with too many fees, and I don't feel like going through all the research and all this to put in, basically 1 cent into one company, and then I'm investing like 1,000 companies or something. That's that sort of a mentality. If I'm going to be diversifying my portfolio, then I'm going to be diversifying it in the right way. I'll probably just go with a Ray Dalio style all-weather portfolio. Then that's my preference. And that's how most people save for retirement. Most people actually have a job, and then they put it into their retirement account, and as soon as they get out of retirement, then about half of it is taxed. So even if you have $1 million right now, can you live off of 500,000? If the answer is no, especially in however long it is until you retire, probably about 30-40 years for most of you, then the answer is probably no. With all that inflation, you probably could very comfortably off of 500,000. So another question is, what if you had an advisor or money manager instead of self-directing your investments? Well, there's nothing wrong with mentors and guidance and getting a second opinion, but if you're going to go with an advisor or money manager and they take fees out of your investment that are unnecessary, then overall you could lose about half of your total investment. So let's say you have 2 to 5% fees annually on your account. With compound interest, you actually lose a lot. I mean, if you're only making 10% a year, then you're losing half. If you're losing, if it's 2%, you still lose quite a bit. But you also get the reassurance, and you also get the advice and the expertise of someone who's dedicated a lot more time to learning about investing and about these companies. But you have to ask yourself as well, are they the best advisor or money manager in the world? Well, if they're not, then it could be that they either aren't that great, or they're just not very well trained, or they're just wrong. Sometimes people are just wrong about certain investments. So weigh the risk reward. The risks are you don't necessarily get their advice, and you don't get their reassurance that something is going to go well. But the reward is more retirement money, more knowledge, having more control over your future and your finances. To me, it's almost like the same thing as knowing what's going into my food. Am I going to hire a chef to cook all my meals for me, cook it myself, or buy all the ingredients and have them cook it for me? I'm going to come up with a recipe list and then they put it together. If it's something like that, then I don't mind. But if it's something where people are just asking me to approve their investments right away, then probably I'm not going to do that. Because I like to have a specific criteria for all my investments. So what if you focused on today rather than tomorrow? And I don't mean this in a strangely philosophical way. I mean, it sounds very significant, more significant than I meant it to be. But I think you can look at this in two ways, basically. If you focus on today rather than tomorrow, then you could say that this is a YOLO mentality and it's not actually worth anything because there probably will be a tomorrow. But at the same time, what if I mean don't worry about tomorrow? And I also, I didn't want to say this because it doesn't sound good and I want to save room when I'm typing. But what if you not only focused on today, but you're not focused on yesterday? So if you're focused on today, then that's the best way to get prepared for tomorrow. Because a lot of us put off tomorrow and put off doing the task today because we think we're going to do it tomorrow. But how many tomorrows have there really been in your life? I'm willing to bet that there's probably been quite a few. And some people die just still waiting for tomorrow and then wondering what happened if they did something even today or yesterday, 10 weeks ago, 10 years ago. It's like what Ty says and what he says that the other person said. Some people, oh gosh, I forgot the quote, but he said something like some people watch things happen, some people wonder what happened, some people, whatever the phrase was. You shouldn't wonder what's going to happen. You should be proactively making it happen today and living in today. I read a book by Dale Carnegie, and basically he says you need to live in day-tight compartments. So what does that phrase mean, day-tight compartments? That's sort of a vague, sort of strange phrase. Day-tight compartments, basically what he's talking about is if you imagine a boat and how it has these different gates and iron doors that close off from water from leaking into the other compartments. Basically, if each of those compartments represented one day of time, then you need to live in each compartment as it is. You can't let yourself live in the compartment that's already flooded with water, because that's already happened. So you have to be in the one that you're currently in and then move on to the next one. If you're doing one task, then you focus on the next task. You're not trying to overwhelm yourself. You're not trying to worry about the anxieties of yesterday or the anxieties of tomorrow. You're trying to anticipate tomorrow. You're trying to anticipate in the sense that you need foresight, but you're not trying to put more emotion into it than is necessary. And the best way to get ready for tomorrow is to get ready today. So that's the task that you need to think of. That's the mindset that you need to go in. And on sort of a related note, what if you didn't get the most important task done today? For me, the most important task, is doing these live streams, and it's slowly building up all the content strategies and all the different web pages and stuff. Look at this page. I think that this page looks good. I think it looks great. I upgraded the quality of the stream and been answering questions on Facebook and maintaining my positions and monitoring them. I started with the positions, those were the most important thing, but then those slowly became not necessarily the most, the highest priority task that I could have. And what did become afterwards? After managing all the positions in my personal accounts and my public account and all the private accounts, then what became the task? Well, it started becoming, how do I build the hedge fund? And you build the hedge fund by doing marketing and getting the infrastructure in place so that I can scale. Getting all the websites in place and all the different web pages for some of the upcoming excuse me, I don't know what's up with my stuff, with my hiccups and my burping today. Excuse me. So if I didn't get the most important task today, what's my most important task? Well, it's probably getting my squeeze pages up and getting all the content planned out a little bit more and figuring out how I'm going to record. So let's just say it's the squeeze pages and the lead magnets that are associated with that. Well, then I might put it off to tomorrow, then I might lose momentum, and then a week from now I might not be as far along as I wanted to. I might not have a list built, so then subsequently I wouldn't have a list going into promotions and all that different stuff. And then it's like, if I didn't get that done today, it could send me 7 weeks back if we're gonna multiply it by exponentially. But if you get the one task done today, how much further could you be? So instead of being 7 weeks behind, I'm on schedule or slightly ahead. Maybe it took me a little bit longer, so maybe I'm only like a couple days behind. But I think getting 1 day ahead, or potentially even 7 weeks ahead, is better than definitely being 7 weeks behind. And in a lot of cases, you can get done in 1 day what usually takes most people a month, just because you're actually willing to do it. So that's the important part of getting the most important task done for the day. So another thing, a lot of people ask me questions that I think just could be answered on Google. They say, well, what's a good book? How do you do a cash flow discount valuation? Not that there's anything wrong with those questions, but you can definitely Google those questions and then you'll come up with a reasonably good answer. Or they say, I don't know how to do it. Could you just show me how to do it? Could you just tell me the answer? Well, I guess I could, and I'd be happy to. But at the same time, I'm sort of concerned about your state of mind. It's almost like you're not thinking for yourself, even though we're all people that like to think. There's just that inherent level of laziness. And I know I'm the expert and, I should be giving people the answers all the time, but at some point you need to start finding your own answers. So that's a little bit what this is about. And I know that I ask for people's questions, whatever, fuck off, kill yourself. This is another thing. It's supposed to be significant. It's supposed to be significant. This is supposed to be a lesson where you just play chess while everyone is playing checkers. I want you to play with aces while everyone else is playing with a 7-2 offsuit. I want you to play on a higher level for your mind and think about actions and counter. Okay, so what I like to say is life is about moves and counter moves. So if someone makes one move, then I'll make another move. if someone makes a move, then I'll make a move to counter it. And if I make a move and then they can't counter it, then that's expected because it's me. But no, seriously, everything is about moves and counter moves. Boxing, hockey, football, all these different sports, chess, writing and interactions. It's all about moves and how you respond to the previous sentence or the setup and what other people have said before you, even content curation, social media, all these different things. They're pinging off other people. So, what if you pretended to know the answer? Well, if I pretended to know the answer to how to evaluate a company's worth, I could either Google it or I could look at their cash flow statements. I could look at their financial statements, all those different kinds of things. I could look at the PE ratios. I could do the cash flow discount valuations, discount cash flow valuations. There's a lot of different ways. What if I could think for myself? What if I didn't need other people's answers every single time? What if I couldn't think for myself? Well, maybe that's the time to learn. But if I can't always think for myself, and by that I don't mean not getting ideas or not getting inspired by people, you should always do that constantly. You need to be a learning machine. But at the same time, you need to be able to synthesize all that information, be confident in your decision making, and then make the best decision. And then obviously the last part of this one is, what if I could ask the smartest people on the planet? And that's when you put yourself in their position, ask them what they would do, and then sort of assume that role for them. So I can't necessarily ask Warren Buffett all the time what his opinion on XYZ stock is, but I could ask him through books and through tapes and through his Berkshire Hathaway meetings, his annual conferences, what his thoughts on investing in general are. And maybe if I get a question, I could ask him based on the valuations and the background and all this, and maybe he knows, maybe he doesn't know, because it's not his industry. So, but what if you could ask the smartest people on the planet a question? Where would you get the answer from? Well, from learning about them and from studying them. And before I wrap up into looking for a top risk reward for opening market, I just want to go into the last question. So what if I had $1 million? How would I invest it? Well, since you're watching this video, I'm going to give you the benefit of me writing something out. And no, I will not share this. This is just going to be a bonus for people that actually watched the entire. Okay. I don't care about naming this document. Okay, so 10%, 10%, 2 times 5%, 40%. Right now that is 60%. And 30%. Okay. Okay, so let's say you have $100 and you're trying to distribute it through you're trying to budget out this $100 of income that you have. How would you break it down? Well, this is one way of doing it. Ty Lopez, he says break it down to 30, 30, 30. Expenses, education, and savings. I have a slightly more complicated way of doing it, but one that also accounts for fun and also education, the necessities, and all these different kinds of things. So if you have $100, what is the first thing you should do? Well, you should actually reward yourself, because if you're not rewarding yourself, then you're not. This is sort of a controversial look on money, because you're saying, no, I should almost, a lot of people might say, I should just always save all my money all the time, never have fun, all this, that kind of mindset. That's true, and I'm as much of a hard ass as anyone, but at the same time, if you're not rewarding yourself for good behavior, then you're going to move backward. And if you don't enjoy making money, then you're probably going to get set back. So you need to set out a small amount that you need to spend within the next 30 days for every little bit of money that you have. I don't care if it's a book, if you enjoy reading books, but you need to spend a little bit of that money right away. So let's say I have 10%, I make $10. And then this is the fun jar. Because it's all about having fun. So now I have $10 to spend on fun. So this equals 2 times $5. So what would I need 10% total, or 2 times 5% of that money for? I'm going to make this slightly more clear. Okay. So the reason why you have two things for 5% is you're going to want things that are that you want to save up for. Maybe it's a little bit of debt, or maybe it's a little bit of a fun accessory, or maybe it's some I don't know, some blankets. Maybe you just want some new blankets or something. Maybe you want an ATV. I don't know. This is what's called the LTSS jar. Wait. This is what's called the long-term savings for spending money. So I know that about this one 7-year-old kid where he saved up a lot of money. He combined his fun jar and his 2 LTSS jars, and just from his allowance money, he managed to save up and buy an ATV. And he actually managed to do that. And, it got shipped through Amazon or whatever. But then his parents ended up needing to repair it, and they didn't tell him, just because they want to reward all his good behavior and whatever. I mean, they spent more on repairing the goddamn thing than having it bought and shipped in the first place. But in the end, the kid thinks he wins, and he wins he actually does win, because he gets himself a whole ATV. He's 7. Let's say you want to get the new iPhone or something. You want to get an iPad. These are the things that you want, but don't need right away, and it's not necessarily the super short-term savings like the fun jar. So where does the bulk of your income, where does this 40% come from? Well, this goes into, you probably already know the answer. But this goes into the necessities jar. Oh. So this is all the essential stuff. This is your bills. This is your groceries. This is your, what else? Bills. I mean, that's really all I buy. Just bills and groceries. That's all I have. It's your car payments. It's your car. gas, I mean. It's all the things that you need to do to just live. 10%. Where does this extra 10% go to right here? Huh. I think I actually forgot. Oh, no. There we go. So you have this 10%. Now, this 10%, this goes into savings. This is the jar where you're saying, I want to have a large nest egg when I retire. I want to build up my rainy day fund. I want to have money in the future. And then this is something that you'd never ever touch. You'd have it automatically taken out of your account and never even see the money, and then it's just in the account for when you actually retire, and you just never look at it because you don't want to get tempted. However you want to set it up, just do it like that. But through the miracle of modern banking, this kind of stuff is possible. And this last 30% or $30 out of the $100, where does this go into? This goes into the education jar. Savings or spending. This goes into the education jar. So this is the jar where I actually think you're going to make the most money. And when you reinvest in your mind, you're actually reinvesting in your portfolio, your business, your real estate, whatever it is. You're actually reinvesting in your finances, into your bank account. So this could be seminars, it could be books, it could be, ebooks, audiobooks, Kindles, in-person conferences, coaching, mentoring, all these kinds of things. If you're learning, then you're earning. And I'm just going to go end this by saying thank you for watching. I'll try and find you a risk reward. Let's go find GoPro. This one I think is good if you're playing the downside. I mean, the upside, maybe the gap will fill, but I feel like for the next few days it's going to run a little bit lower. Twitter, same thing but opposite. I feel like tomorrow it might run a little higher. Probably going to fill the gap, but if it doesn't fill the gap, then you're looking at some decent upside. Check out Pepsi. I don't really like that setup very much. It's okay, it's fine. Nike, nope, not even. Las Vegas Sands, nope. Netflix, Google, that's okay. Southwest Airlines, that looks, it's okay. Facebook, LinkedIn. Well, yeah, same deal as Twitter. If you think that it, right now is probably going to run a little bit higher for the next few days, so you can make a small pop of cash, but usually you'll see it sort of a, it isn't exaggerated as right here, but right here you see it just sort of runs a little bit higher for the day and tries to reach new highs, but it doesn't quite make it. and then just starts to sell off. It just runs a little bit higher each time and then sells off. So you can get into this trade for a little bit of extra cash. Oh, okay, there it is. It's basically this right here. It'll just run a little bit higher and then it'll sell off massively. So basically, if you're going into this trade, then that's what you're looking for. It's a top day trade. I wouldn't say that's necessarily the best setup, but let's look at Wells Fargo. You know, I actually really like this setup. I think I might actually get into this trade as well. Okay, so let's look at risk reward. I'm thinking that it can make it to that line right there kind of concerns me. It's not all-time highs, so it could start breaking down right around here. But I really like this setup. Because you see right here, it sort of went flat and then sort of outperformed, and then really started to outperform, where it actually broke past that upper Bollinger Band. Yeah, this is nice. I like this chart a lot. This is looking good. Okay, let's look at America. I know Bank of America is outperforming a lot. I was kind of just curious. That's not actually something I'd get into necessarily right now. Goldman Sachs. Yeah, also outperforming. Not quite touching the upper Bollinger Band, but it's a much wider. It's pretty far from the 7, so not ideal. If we're right here even, and going right here, then that's something I would like to see. JP Morgan, wow. Yeah, financials looking very strong today. So yeah, generally the utilities are way down, financials are way up. Everything else just sort of neutral to bearish. Let's check out. Is my stream even still running? I would hope that it's still actually running. That'd be kind of funny. Yep, still going strong. Okay, sweet. Let's check out. Let's check out Microsoft. I saw some things in the news about them, about it. So, no, not strong. Oracle, nope. Trading pretty flat right now. Best Buy, okay. Harris Corporation, maybe Verizon. Check out Apple. Apple holding strong. Yeah, this is looking okay, I suppose. I'd want to wait for it to flatten out a little bit. It could end up being something like this, where it just slowly grinds higher, but that's actually something I'd like. Okay. I actually like this a lot as well. That's looking pretty solid. And I like where Apple went on earnings, and I like where Apple went on and I like where they're headed as a company. And right now, it's actually a decent time to get in, just because it's probably going to head higher in the next little while. So let's check out Apple trading software. Whatever your trading software is, learn what that is, learn how to execute trades. Okay, same type of action. Okay, so for this one, I'm going to say go 3 months out, and as a tip, you don't actually need to worry about it until it is you don't actually need to worry about it until it's 3 weeks out when you're buying a position, because then that's when you get heavy volatility. Right now it's trading at 119. I'm just going to go 1 strike in. Spreads are looking good. Applied volatility 24. Delta 58. Okay, I can live with that. Gamma less than a penny. Theta 10 cents. The theta at 10 cents kind of concerns me, but it's sort of like this, 6-to-1 ratio, because you're going to combine this, and it's a little bit less than 6-to-1, but maybe like 5.5-to-1 ratio with making versus losing. So if you have any halfway decent day, then it's going to make it up. I'll look at the past. Let's look at the past year with the 52-week high and low. So I'm going to place a 3 month. 1, 2, 3. Could be looking at something like this. Then 1, 2, 3. Could be looking at something like this, or even this. Hopefully it doesn't taper off to nowhere land. But yeah, I'll just say April 17th, 118.57. Wow, that's a strike price. That's weird. They're going off into some weird tangents with their strike prices. Usually you see it at 75 cents or something else, but they're just going off into these different kinds of cents. Wonder if the monthlies are any different. Yeah, monthlies are definitely different, but the weeklies are definitely a little different. So if you can get 1 or 2 strikes in the money for Apple and get their April 17th call, then I would say that's top risk reward. Exit once it hits 130 and take your profit. You could even exit earlier than that if you want to. If it dips below, let's say, you could exit at 117. You could exit at 115. 115 is probably the more likely target. So let's just say you exit at let's just divide it. So if to 116, then exit. Make sure that you cut your losses. But I see this going up in the future, so if it goes to 130 or higher, then take your losses there. But you can definitely exit earlier. I mean, personally, if it made it to 125 in the short term, then I'd definitely exit. And if it made it down to 116 in the short term, I'd definitely exit. That's just me. Typically you want to have a 3-to-1 risk reward ratio, so that's 3, and then yeah, I'd say 130 versus 116, and that's what you're looking at. Yes, I'm gonna cut the stream, and it was nice. It's nice with this being only 1 hour instead of having this be 2 or 3 hours. Anyways, cheers.